Thursday, June 4th, 2020, Monaco 64, home of alternative economics and contrarian views. Today I want to talk about how we've got all the ingredients of currency collapse or hyperinflation or complete loss of confidence in national currencies in the West. And this is something that is unprecedented, I would say. In general, yes, we've had such collapses in Germany in 1923, of course, and other less developed countries like Zimbabwe, Latin America, of which I have experience of as I grew up in Brazil and saw many different currencies come and go when I was growing up in the 70s and 80s. But yes, things are very crazy right now. That's the only thing I can say. Not only the socio-economic situation, but the financial and the markets. They're crazy, I think. And I think it's affecting people psychologically. And hyperinflation is a purely psychological phenomenon. It's got nothing to do with supply and demand. It's when people lose faith in the issuing institution, currency issuing institution, and by that I mean the state, the institutions of state like your treasuries, your central banks, your banks. People completely don't want to hold that paper currency, and they try to get rid of it as quickly as possible. I know it's not started yet. I know the stock market has rebounded quite a bit, but I think this is all part of the symptoms that we're getting right now. And so I've said before that a lot of debt is one of the precursors of hyperinflation. And why is that? Well, because there's so much debt that needs to be defended, that central banks will start monetizing that debt. We're seeing that now, and no one can deny that. You look at the Fed's balance sheet, how it's gone from 3.6 trillion last year when they stopped doing the quantitative tightening to now over 7 trillion. Today, of course, we're going to get new numbers for the Fed's balance sheet. It is over 7 trillion. We'll have to see if it's accelerated even more. Something the Fed is slowing down with its QE. It might be. And how come the market keeps going up? Well, because just by telling the market that they're there for them, the markets have the confidence to do some of the Fed's work. But I think the Fed is far from over from this money printing. Today, we're going to get another central bank that will probably announce even more money printing. We've got the ECB today meeting. They're not expected to change rates. But this is from investing.com. This is a comment from an analyst at Nordea. It's a Scandinavian bank. And it says, we believe the ECB is ready to ease monetary policy again. How much more can they ease it? Said analysts at Nordea in a research note to clients. This time, by raising the Pandemic Emergency Purchasing Program, or PEP. So they've got a name for all these programs. They need to make sure they tell the market, well, this is because of the pandemic, not because European banks are almost ready to collapse unless they keep saving them, right? By 500 billion euros. So they already announced 750 billion, the ECB, a few weeks or months ago. Forget now exactly, after all this started. So, and they're looking to increase it by 500 billion to 1.25 trillion, and possibly even signaling that the purchases will not end by December 2020. What about the markets and the fact that we're now seeing that the markets are pricing a V-shaped recovery for the economies or perfection. But we keep hearing in the background that we might get a second wave of this health crisis. So just to show you why I think the market is getting ahead of itself, as I've said before. But then again, back in the 20s, when Germany was in a hyperinflation, actually having businesses, owning businesses that were based on real things was a good thing. So some of the issues in the stock market might do well, some companies, but we'll have to see. It's all very, very confusing. I think people need to be really careful. I think they could get hurt a lot from the situation. So yesterday I looked at the Telegraph, and this is what they've got in the business section. Quarter now furloughed as deadline looms. So quarter of the workforce in the UK is furloughed. It says workers on state support hit 8.7 million as government is urged to press ahead with national insurance holiday. So things are not great. And this furlough, I think, is going until October, but the employers will need to contribute a lot more as of August, I think. And the deadline for applying for furlough, I think, is next Wednesday. So it says more than a quarter of all workers are now on state-funded furlough as companies scramble to sign up for support ahead of a deadline next week, highlighting the scale of the battle ahead to restart Britain's economy. So, the government and the Treasury, they're making it seem that they're trying to cut costs, that this is costing them too much. But I think in the end of the day, they're going to have to come out with another stimulus. That's the other thing that the market is discounting, that despite all the political mayhem in the US and everywhere else, they expect more stimulus from Congress. So that's one thing you can be certain of. We're going to get more money printing, more stimulus, more debt. So that's a huge ingredient for loss of confidence in the currency. The other ingredient is high unemployment, an economy in depression. And a very important one as well is the political and social climate. And I've taken a passage from this book, When Money Dies, by Adam Ferguson, The Nightmare of the Weimar Hyperinflation. And I want to go through it, through this passage. And it's very important, especially with what's happening today, not only in the US, but it seems to be spreading. There are protests here, even here in the UK now. So it says, to ascribe the despair which gripped those nations entirely to inflation would, of course, be misleading. In the winter of 1918-1919, all three underwent political revolutions, allowing the deprivations of wartime and crushing military defeats, so that conditions were fundamentally unfavorable to any revival of national spirit not rooted in revenge, and would have remained so even had the peace treaties permitted the losers to struggle, however gradually, to their economic feet. It is not always clear what events, what popular uprising, or allied ultimatum, or political assassination contributed to the inflationary panic, or which were themselves directly or indirectly caused by the ceaseless depreciation of the currency and rise in the cost of living. Undoubtedly, though inflation aggravated every ill, ruined every chance of national revival or individual success, and eventually produced precisely the conditions in which extremists of right and left, sound familiar, could raise the mob against the state. set class against class, race against race, family against family, husband against wife, trade against trade, town against country. Wow. If this doesn't sound familiar to you, I don't know what does. With the lockdowns as well, you've seen even families everywhere around the world get at each other's neck. I think this is so familiar. And now with the riots in the U.S., you could be describing events nowadays, I think. It undermined national resolution when simple want or need might have bolstered it. Partly because of its unfairly discriminatory nature, it brought out the worst in everybody: industrialist and worker, farmer and peasant, banker and shopkeeper, politician and civil servant, housewife, soldier, merchant, tradesman, miner, moneylender, pensioner, doctor, trade union leader, student, tourist, especially the tourist. It caused fear and insecurity among those who had already too much of both. It fostered xenophobia. It promoted contempt for government and the subversion of law and order. It corrupted even where corruption had been unknown, and too often where it should have been impossible. It was the worst possible prelude, although detached from it by several years, to the Great Depression, and thus to what followed. So there you go. I think we're very close to getting all those ingredients as well. So that's why I think we are in a very dangerous period of time, unprecedented. As I said earlier, this is not just happening in a few countries in Central Europe after World War I, Germany, Austria, and a few others. This is happening to the whole world, and this is happening to the major world power, the United States, that has the major world currency or reserve currency. So again, and I'm not advising people here, I'm just saying I think it's very dangerous to have a whole lot of these pieces of paper, all these fiat currencies as savings. The stock market, that's very dangerous as well. I think hard assets are a place to be, in my opinion, and even that is not certain. So that's why I'm sticking to precious metals, gold and silver. What about cryptocurrencies? Some people think I've gone off cryptocurrencies. I haven't. I just think that cryptocurrencies are very volatile. They're not stable, and they don't have the track record. But I'm not saying you shouldn't have some. I have some, but not a proportion that would make me not sleep well at night. So I would stick more to the precious metals. Stock market, well, the stock market is like owning pieces of companies. So you need to do your homework and decide whether these companies you owned are worth owning and whether they're worth buying at the current price levels. So I said that I think hard assets are undervalued versus financial assets. So I'll show you quickly this chart here. I took that from Incrementum. They did a really good piece on gold. I'll put a link again to it in the description. In Gold We Trust. It's a report, annual report they do. But they put this chart here that is really interesting. It's the Goldman Sachs Commodity Index versus the Dow Jones Industrial Average, the ratio. And it's never been as undervalued as we're now since 1900, hard assets. What does that mean? Well, it means that relative to the stock market, commodities are the cheapest they've been in over 100 years. How could that correct? Well, a few things could happen. You could see commodities start going up quicker than the stock market. You could see the stock market drop quicker than commodities, or you could see the stock market drop and commodities go up. I tend to favor the last one, stock market down, commodities rising. That would be pointing to a stagflationary, maybe even hyperinflationary environment, loss of confidence in the currency. And is it possible? I mean, because most people think, oh, this kind of thing only happens in Zimbabwe or Brazil or Venezuela. But I would say with what's happening nowadays in the developed world, not only politically, but with the crisis, the health crisis, the riots, these are things we've never seen before. These are things we've never experienced. The fact that we can't travel anywhere around the world anymore, the fact that we can't talk to people outside, we can't socialize. So we are in unprecedented times. So I think the chances of currency collapse are growing. So that's my warning for today. Let's finish by looking at these markets, crazy markets, right? So it's 8:51 a.m. London. I'm a little later today. We've got spot gold at 1702.70, so it's up about $4. So yes, what happened yesterday? Well, with the Dow over 500 points, money flowing out of safe havens, even treasuries went down yesterday. Their yields went up. People were just piling into the stock market, into riskier assets. So they got out of gold and silver. But in spite of that, gold is still at 1700. So yeah, I know the bullion banks probably are trying hard to get it down. But considering we got to around 1460 in March, I think gold's still doing pretty well. Yeah, it doesn't look like we're going to get to 2000 by the middle of June or next week, but that's not important. The gold silver ratio is still below 100. Silver is underperforming right now. We're at 1755, down about 10 cents. Surprisingly, the Dow futures is down today, down 100 points or so, a third of a percent. Currencies, they're losing ground today. The dollar had been hit hard the last few days. Now it's switching to the other side. The pound is down 0.5% at 125.16. The euro is down 0.25% at 112.03. Crude oil WTI is down 2% at 36.66. The 10-year yield is at 75 basis points. That's down 1.2 basis points. So yeah, yesterday I think we were below 70 basis points. So yields did rise and prices did go down. The price of bonds, of course, they move inversely, the price and the yield. So yeah, my conclusion for today is, be careful out there with your holdings of fiat currency. I think all the ingredients for a loss of confidence in fiat currencies are present today, and it could really decimate people who are on fixed incomes, who have accumulated a substantial amount of fiat currency savings through their working lives, people who are on government salaries as well, pensions, and as we see now, a quarter of all workers are being paid by the government in the UK. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.